Hey everyone, we are continuing our expert series, and our experts are so gracious. Even when they have a busy schedule on the day we do it, they just move it around. And that means today we are bringing Jonathan Twomley on a Wednesday. How you doing, Jonathan?
I'm great, Michael. I wouldn't miss this. I would shift everything around to be on this podcast. This is, like I always say, one of the highlights of my week. So happy to be here.
I love it, man. Well, we got a lot of topics today, so we will just jump in. And one of the things I really like about what you're doing, and let's make sure we plug your Facebook group again, because that's something I look at every day, is you put out an article to your group basically asking for their opinions. I think it was Monday. And it was about an article, I think it was Seeking Alpha, was 42% of the unemployed jobs are not coming back, if I remember the headline correctly.
Yeah.
Curious what you thought of the article when you read it. I certainly have my thoughts, but why don't you go ahead and talk about that one first?
Yeah. So unfortunately, I can't place my hands on the article right now because I don't have time to dig through the whole Seeking Alpha site to find it. But the gist of the article was that someone had done an analysis that, and I believe it was it was the University of Chicago, right? Economics department, which, if you know, is a very conservative. Yeah. I mean, they're legit, but they're also there's legit economics departments across the spectrum, but they happen to be a very conservative economics department. And they did a study trying to figure out what the long-term impact of COVID is going to be. And their assessment was that up to 42% of the jobs that have been laid off are never coming back for various reasons. And, the reasons range from, that restaurant went out of business to, just fundamental shifts in our economy that this is going to accelerate, like the shift towards automation. I was reading actually another article that just happened to jive with this morning about how, again, on Seeking Alpha, about how companies will use COVID, as they do with every downturn, as an excuse to accelerate their restructuring plans. It's an opportunity for them to cut out the fat in businesses. It's also, a great opportunity for them to invest in technology that will make jobs, will eliminate jobs. So the argument in this Seeking Alpha piece, we're talking about this study by University of Chicago, was that it's going to take a couple of years for all those people for that 42% to find other work. Either some of them might need to be retrained, they might need to move. So it's not going to be a quick V-shaped recovery once this comes back. So I think that this is something people need to pay attention to, because even when the economy reopens, and I know that we've seen the economy, in places where the economies have reopened, you've seen all the coverage on TV, like, look, it's packed, everyone is out shopping, and there is pent up demand for sure. And I think that's what you're seeing. Like you're seeing, all these people running out to get haircuts and to go to bars and do the stuff they haven't been able to do for a while. But that's just like opening day, right? And the analogy is like, everybody who's been anxious to get out there went out and did it on the first day. All the other people who didn't really care one way or the other didn't run out the first day. So what you have to see is like how this plays out over time. And I think the analogy is going to be the data you've seen from the credit card companies, which is when the lockdown started, credit card spending spiked because everybody ran out and bought as much toilet paper as they could get their hands on, and everyone was panic buying, and they were, everything was sold out in the supermarket. But after everyone stocked up, then credit card spending basically like dropped off a cliff. And so, I think a lot of people too, like if we're indicative of any other households out there, like we went and we bought all this stuff because we were worried about not being able to get our hands on it later. We stocked up the freezer, stocked up the pantry, stocked up everything. And we also bought like a bunch of junk on Amazon for the kids because the kids were bored out of their minds. and we were like, we bought them all this stuff that we wouldn't ordinarily buy them because we felt bad for them. But like, that all stopped. Like we haven't continued to buy them
No.
everything they ask for, after the first couple of weeks. They've adjusted to the new normal, and our pantry is full. We can't fit anything else in there. And, it's like that's happened a lot. So I think the same thing is going to, when everyone's saying, oh, look, the economy's back, no problem. The bars are full. That's even putting aside whether there's going to be a second wave, which there's indications that in the states that are reopening, they're seeing a spike.
Yeah.
But there's what I've always argued, and why I agree with this article from Seeking Alpha, is that, let's just say 10% of the people in the world, or not in the world, but in the United States, 10% of the people in the United States are anxious about going out after everything opens. They don't want to go into crowds. They don't want to go to restaurants. Just 10%. That is going to have a very significant economic impact, and that will affect jobs. And I think I would be really surprised if anybody out there were willing to argue with me that like 10% of the population is wary about going out. Right. Yeah. Like, I don't think that's, I think it's a silly argument to make that like 100% of the population is just going to go right back to doing what they were doing.
Oh, there's no chance. I'll tell you right now, my wife is, she's at high risk. So she has that going for her, but she has no interest in going out. She has been outside like 5 times in the last 10 weeks, like just outside. Yeah. She's like, no, honey, you go get the mail. You take the garbage out. Like, she's not going out.
I mean, I wasn't even thinking about the high risk people out there, but the United States has got more cases of this than like anybody in the world. And one of the things that I've read is that part of that is because, it just happens to attack the very problems that Americans had before this happened. So like, if you're obese, if you have diabetes, if you have heart disease, like all those things, like you're like a magnet for coronavirus, right? Yeah. So, and all of those were health problems that we had before this happened. So it's kind of like we were set up and waiting for an extra bad impact, just in the same way that the markets were like set up because they were overvalued. Like Americans themselves were like overvalued. They're like too fat and too unhealthy. So this was just like, we were set up and waiting for this to happen.
Yep. I agree.
So, so when you think about those people who really are at risk and are taking it seriously, then they're just not going to be out there spending as much money as they did. And I think there are other people out there like me, like I've just gotten used to not going out, and I'm kind of thinking like, I'm not really feeling like, not that I'm like worried, but I don't feel like I've gotten used to not going out. So I think like my habits have changed. I've gotten used to bringing lunch from home, and I've gotten used to like doing all these things I didn't do before.
Right.
And
I think you're right. I think consumer behavior has changed. And if you're not paying attention, the US is a consumer driven economy, right?
Yeah. It's like 75% or 80% of activity is consumer driven.
Yeah. So it is, unemployment is going to be far stickier than people are expecting, which I think is really the point of the article. Yeah. There certainly will be a recovery at some aspect as people come back, but it won't be nearly as much as we want. And it will be a long journey back, because the other thing I'm seeing is the big box retailers, for example, like, again, I reported on Target and Home Depot and Lowe's and all those people the last couple of days. They're winning and they're hiring people, in fairness, but they're doing that at the detriment to the small business. The small mom and pop retailers, just like the small mom and pop restaurants, most of them aren't going to be here. We could be down to 10 retailers, theoretically, and that's jobs.
Yeah. And also, I mean, what you're seeing too is that those big employers, because they have a lot of people who are looking for jobs, are using that to their advantage. And they're hiring people with like the lowest wages possible, no benefits. So even if some people are able to shift from working for a small restaurant to working for a chain, or, working from the mom and pop hardware store to working at Lowe's, they may, I mean, who knows? They may be better off. They may not be. But I think there's going to be, not all of them are going to get those jobs, right? Lowe's doesn't need that many people,
right,
at the margins to to make up for, because they have these enormous economies of scale. So, I think here's also a prediction that I'm going to make now.
Okay.
When the economy reopens, what we're going to see in the data is we're going to see this enormous drop, right? in economic activity.
Oh, for sure.
And the chart's going to go like this, and then it is going to be V-shaped coming back as stuff reopens. And what's going to happen is everybody's going to point to that and say, because when it drops, right, there's always like really strong economic growth at the bottom of a recession, because it's just a number. It's like a smaller amount of economic activity. It's like
the marginal change. Yeah, it just has a greater
exactly.
impact.
It's like the denominator is smaller, so you need a smaller numerator to make a bigger percentage, and that's what. So we may well see like 10% economic growth.
Oh, it will be. I'm on record. Q3 will have a record bounce in G, and they're going to talk about the percentage. That's all they're going to talk about.
Exactly.
It won't be the number.
Right. They're going to talk about the percentage. So you and I are on the same page. They're going to talk about, and everyone's going to point to like record economic growth. But the fact is, we're not going to be back to anything close to normal, right? We're not going to be back to full employment. We're not going to be back to even. I mean, we're still going to have like really, really high unemployment at that point.
Oh, so for sure.
It'll be interesting to see how, and I'm sure like the stock market's going to bounce because of that, and like all the real estate investors are going to say, look,
it's
over, and we had 10%, and then they're going to go and the real boneheads are going to then project 10% growth forever into the future, right? They're going to say it's a new normal, 10% growth forever.
Yeah, the U.S. can do it. Yeah.
Yeah. So.
Oh, my scariness. Yeah. So I think that article is. I think it's really pointing to. I mean, just to quote other I guess letters. It just points to an L-shaped recovery, in my opinion, right? Or the Nike swoosh, or whatever you want to call it. Maybe it's a slight uptick, but jobs. I think we've talked about it. I think unemployment stays above 10% through 2021, right? That's 6 quarters. So
that's pretty pessimistic. I'm not sure that I'm that pessimistic, but I could see 8 for sure persisting for quite a while.
Very cool.
And
and again, right, as a real estate channel, that all goes to rent collection and tenant turnover and doubling up and all of that stuff. That's why we watch this stuff, is because it impacts our investing decisions. So.
Yeah, and you have to, and the idea that as we've talked about before, the idea that somehow rentals benefit from the economy being bad, it just is nonsensical.
I'm so glad that is going to go away in the next cycle, right? Because that was a statistical anomaly of taking 4% of people who own homes, shoving them back into apartments because they should have never been homeowners last time. I'm glad that's going to go away in this crisis.
But listen, and again, it wasn't just a statistical anomaly. There was also a timing difference there, because it happened after the recovery. It happened well after the recovery began.
Oh no, true. Yeah.
So the peak of the housing crisis was 2010.
Mm-hmm.
The recovery started in 2008 or 2009, right?
Yeah.
So at the peak of the recession, you had vacancy spiking in rentals.
Yeah, of course.
I mean, because people lost their job.
Yeah.
And economic vacancy spike now is followed by actual vacancy, right? Mm-hmm. And people were doubling up. So then you had this foreclosure crisis, then pushing all these people into multifamily afterwards.
All right.
But it's not, or into rentals, not just multifamily, but into rentals afterwards, because that's how it actually happened. And you're right, that will not happen again. If it does, if we have a massive foreclosure crisis this time, starting out where we are, that's a serious problem. I mean, that's like a depression level event, because we're, last time we had that cushion, so to speak, of like that extra 4 to 5% of people who really shouldn't have been given mortgages.
Right.
But we don't have that cushion again. No. So if we were to drop 5% from where we are now, that would be a serious problem.
That would hurt.
Yeah.
All right. Let's, the next article that we were talking about is, you found an article that was kind of trying to put into scope, what kind of markets, or how many markets are really being helped by the, the stimulus checks, right?
Yeah.
What percent of them? I think it was 34 markets.
So there's an interesting article on Market Watch today. Actually, it's yesterday. They posted it late last night, so dated yesterday, but everyone saw it this morning.
Okay.
Talking about the economic impact of the stimulus payments that people got. And, so let's put this in context. We've been talking a lot over the last couple of months about how rents have held up so far, right? And some people are saying, the one extreme, like, see, everyone pays their rent; they're always going to pay their rent. Somewhere in the middle, they're saying, like, well, look, we got the stimulus money, and people are using it to pay their rents with, and that'll continue. And then there's debate. Some people think that there's going to be more stimulus. We'll see.
Yeah.
But the point of this article, though, is that someone actually decided, like, hey, let's actually analyze this rather than just yakking about it.
Yeah, let's do the math.
Let's do the math and try to come up with some parameters here. So they did an analysis, and so for an average family of 4 who qualifies for the stimulus, because it peters out, it caps, right? So for a family of 4 that qualifies for this, that's $3,400 that they got in stimulus.
Okay.
And the analysis was that the average 4-person household in the United States has monthly expenses of about $7,500.
Wow.
So $3,400 pays for half of the expense that they have for a single month. Now, there are some markets like McAllen, Texas, they said, where the average household expense is right around the amount of the stimulus.
Mm-hmm.
So they got a month of expense. But mostly around the country, they said there were only 34 markets where it covered half of the monthly expense. And it says 8 out of the top 10 cities, the economic impact payment only covers between 60 and 71% of the average monthly expense. So that suggests to me that, at least as far as the stimulus money, the original stimulus money, or the bonus, whatever, that one-time payment that people are getting, that people may be paying their rent out of that, but they're having to dig into their savings to cover their expenses. Now, they may also be getting unemployment, and we've talked about how they're getting an additional $600 top up
a week.
Now, there was an article that was talking about this too, and I wasn't able to find that.
Well, let's first talk about the 34 markets, because the other thing that I think is, at least I haven't heard yet, is a large percentage of our population is still getting their paycheck, right? The $3,400 check went to everyone. I did not get one, but but I understand that it went to everyone, right? It wasn't just
to everyone who was
below 120.
I thought it was
150, maybe. I don't know. Some number.
But there was below some number. Below 150 per household, it started to
peter out.
But and it stops completely at 198,000.
Oh, okay, yeah, all right,
per married couple.
Gotcha.
So I'm sorry. So what was the question?
So I was just pointing out that the $3,400 that they were getting on an average of $7,500, that's all families, is what I was highlighting.
All families below essentially 200,000.
Not unemployed and employed.
Right. Yeah. So it doesn't matter whether you're employed or not.
Yeah, because the reason that's important is because what I've seen just in the data is the bottom tier was hurt the most, right? 40% of the folks impacted made less than 40 grand a year, which meant you were probably in retail, you were probably in restaurants. You weren't a tech worker, right? You weren't in an office pounding on a keyboard. And I'm just guessing if you would have bifurcated the data to the bottom tier, it would probably be much larger than 42 or whatever it was, 50%. Because I think this is sometimes when we get data that's all mixed, right? We treat everybody the same, and then we do an average, but we're not realizing that this event hurt the bottom the most.
Exactly. Yeah, well, that's what we're going to talk about that in a minute, about how what's going on with different classes of property.
So that's where the rubber meets the road, right?
Yeah. So this is a good segue into the next topic, or one of our next topics, which is how multifamily rents are holding up. And so there's been a lot of very positive press about how multifamily rents are pretty close to normal collections, right? So they're trailing by about, according to the data that is being published, they're trailing by about 2% over where they were last year.
Right.
However, there was an article that came out last night in National Real Estate Investor about why multifamily rents are holding up better than expected. And the kind of, the interesting data in here is actually that the software systems that they're using to collect this data are disproportionately used at institutional grade properties, right? And so that the data is for the A and B properties, this is what's being seen.
Yeah.
The problem is this is not capturing the C-class data as or as much of it. And so when you dig into the C-class data, what you're finding is that the C-class properties are down a further 5%. So they're down 7% versus last year's collections. And so a couple of interesting things about that. So first of all is that if you're down 7% in your top line rents,
right.
and it's also not talking about the other things that are not being collected. That's just rents, right? So late fees and other things that a lot of people are waiving, you know, you could be even down more in revenue, but let's just take that 7% figure as the figure. Assuming that you're running at a 50% expense ratio, your net operating income is down by 14%. Now, that means that even if cap rates are still where they were, if they haven't changed at all, that's a 14% loss in value right there. However, I would be hard pressed to believe that if an investor looks at a 14% drop in NOI, that they're also not going to want more risk premium in terms of the cap rate they're paying. They have to. So cap rates are going to increase as well. And that just multiplies your loss of value. Now, again, this could all be temporary if you don't have to sell, you don't have a problem. If you're covering your mortgage, you don't have, you can just ride it out. But in terms of like on paper, what your property is worth today versus what it was worth a couple of months ago, things have changed. And if the situation stays this way,
if the trend continues,
right? If the trend continues, and if looking at this issue where if people's rents are if they're not making enough money to cover their expenses, if they're living out of savings, if the additional unemployment bump is allowed to expire in July, then you've got a whole different problem on your hands. If you're trying to refinance right now, it's going to be tough. I mean, the bank is going to look at that data and say, you're going to say, well, look, historically, this is how the property performs. And the bank is going to say, yeah, but we can't tell the future. We're in this fluid situation. We're not comfortable giving you all the proceeds that you want necessarily. So it's going to be difficult for people trying to refinance this year, maybe even next year. And you've also got, I'm just hearing anecdotally, I haven't seen any data on this, but these eviction moratoriums there are some people who are gaming the system. And,
for sure.
And so
guarantee you there are.
And so, I mean, someone just posted in my group today about an investor friend of his who has 300 units in New York City, and they're only collecting 50% because all of their tenants are gaming the system, right?
Ouch.
So that when you go to the bank and you say, well, it's my tenants gaming the system, I mean, the bank they're not going to just take your word for it. They can't lend you money on the basis of you saying, well, I promise it's going to get better. So, this is going to cause some pain for people. So as investors, we have to be, I'm not trying to be all like doom and gloom. What I'm saying is that you have to, your objective as an investor is to not lose money. And you have to be thinking about these issues. You have to be looking at the downside. It's really, you look at someone like Warren Buffett, and the reason he's been so successful his whole investing career is because his focus has been on not losing money.
Rule number 1, don't lose money.
And it's like rule number 3, 4, 5, and 6 as well. Like,
exactly.
It says like rule number there's 2 rules of investing.
Rule number 2, don't forget number 1.
Exactly. Rule number 2, refer to rule number 1. So
exactly.
It's so people who, I think a lot of investors have this tendency to be very optimistic, always look on the upside. They spend the money they haven't made in their minds yet, and they really don't want to contemplate the
Yeah.
the difficult reality of possibly losing money.
Yeah.
So they just ignore it. And I think that that's irresponsible. They
Oh,
have to
for
be
sure.
thinking about these issues.
Yeah, the one thing I've told everybody, I mean, this goes back 20 years for me, is I've always tried to understand the downside. If I can protect the downside and handle it, I just let the upside run.
Yeah.
And the reason I like how we tied these articles together today is we're almost in a parallel universe the last 2 months and maybe even the next 2 months, where there's just extra help for folks that is
Yeah.
making rent collection in parts of our asset classes better than they normally would be, right? I've been very clear. I own C plus properties. My rent collection for May, as of the 15th, beat February.
Wow.
Beat February, right? We're at 99 point something collected. But how we're tying these three articles together, at least as the environment sits now, that's probably not going to be the case in August.
Yeah,
Right? Just
exactly.
given the rules of the game, right?
If the stimulus runs out and is not extended,
Yeah.
and I don't think there's any guarantee it's going to get extended. I mean, I had someone in my
No.
group today saying like, "Oh, the Fed and Trump are going to support, until there's a vaccine, they're going to take care of us." And I think that there's, the Republicans control the Senate, and their natural inclination is not to spend government money.
Yeah.
Right. That's their
default
like,
answer. Yeah.
Their default answer. Yeah. That is their fundamental default position. And so they probably passed a stimulus like gritting their teeth and holding their noses as it was.
I think they knew they had to buy time. I'm going to give them credit on that one.
Well, what I mean is, no, but they had to buy time. That was not their preferred, they didn't want to do it,
yes.
but they realized they had to.
They had to, correct.
But at some point, there's going to be pushback.
Oh, and it's already happening. Yeah.
Yeah.
Right.
I mean, look, the House passed this really generous stimulus bill. It's DOA in the Senate.
Dead on arrival.
Right?
Yeah.
So it's, something will probably get passed. There will be a round two, but it's not going to be, it's not going to be anything like what the House passed. That's their opening bargaining position. They know it. But we'll see what happens in.
Yeah. I need to, what I'm taking for this is I need to be prepared. Where I was initially nervous with April, as we talked about, and it turned out okay. And then May is better than April. Freaking May is better than February. I need to be budgeting for August, September, and October.
Yeah.
Right. That's where the rubber meets the road. The next couple of months are probably going to be fine because the people who are paying want to be paying. I happen to be in one of those markets where the extra $600 is more than the people are making.
Yeah.
So I should expect decent collections through July.
Yeah.
And then we'll see what happens in August.
Yeah. And if you're a syndicator now, I mean, I think most of the syndicators that I've talked to are not paying distributions, which is the smart thing to do. And because they need to save that cash, because look, if everything turns out fine and they get through this and rent collections, like everything stabilizes and people go back to work, they can just pay those distributions. But
one time. Yeah.
If they pay them out now, and then the collections fall short in the summertime, then they're going to be looking at, calling the money back from their investors, and it might be spent already. They might not be able to get it back. So
that's a good point.
It's very prudent of them. It's very prudent of them to be reserving that cash for shortfalls later in the year, potentially. So
yeah, that's a good point. Cause a lot of people were going, hey, I'll pay. I mean, a couple that I know were like, hey, we're going to take April and May. And if things are okay, we'll probably pay in June. But I think that's wise advice. You got to realize we're in that 4-month parallel universe, and it ain't about June, April, and May anymore. It's about August and September under the current rules of the game.
And listen, there's going to be a lot of pressure on syndicators to pay out dividends.
Oh, for sure.
If the news keeps on being good, like, hey, you guys are collecting rents.
Yeah. 99% collection, blah, blah, blah. Of course.
Yeah, I see your balance sheet filling up with cash. Like, I want my money. There's going to be a lot of pressure for that. And, it's going to be tough for the syndicators to do the right thing, which is to not pay that money out, because they really shouldn't be paying it out until it's clear.
Yeah. Until the seas are less rough.
Yeah. Or at the very least, they should be, paying out only like what's up and above their debt service. Like, they should be reserving like a quarter's worth of debt service or something, to make sure that they can get through 3 really bad months.
Yeah.
But beyond that, they shouldn't be distributing.
Yeah, you did have another article about what markets are being hurt the most, I think, or
Yeah, so continuing on the rent theme, so there's now, this is great. We're starting to get some real data on stuff.
yeah,
Another article that came out yesterday, this is in CNBC,
okay,
and this is the 10 largest US cities where rent is dropping the most due to COVID-19.
there we
And
go.
so this is interesting because what normally right now we're in May, this is like high renter season,
Yeah,
generally speaking, right? This is when people are moving, they're
lease ups,
they're thinking about next fall, where the kids are going to be in school, all that kind of stuff. They might be, they've got their summer plans. They want to have this taken care of beforehand. So now is moving season. This is when you usually have the most, new leases at new higher rents. You get the most rent growth in this time of year.
Yep.
What's happening though is that things have really ground to a halt because people don't want to look at new apartments, or people are working from home and they don't have this has now become their office, and they don't have the bandwidth to like uproot everything while they're working from home and like look for new apartments and stuff like that. So it's caused the market to grind down. Now there are a couple of places where rents have been hit hard that I'm sure surprised no one. So Las Vegas, everyone knows Las Vegas is basically a tourism destination. Yeah. Tourism is now dead. So rent growth, that's a problem.
Shocking.
Shocking. New York City, the worst hit by COVID. The fact that rent growth, they've got some rent decline in New York City, not surprising to me in the least. However, I'll tell you, basically every other city on here is a surprise to me. Well, maybe not Houston. Houston's had all kinds of energy, with the oil. I'm not surprised that it's dropping in Houston, but here is where I'm surprised that so the rest of the top 10 list, this is not in order, this is just the map. So the rest of the top 10 list, as we've said, Las Vegas, New York, and Houston. Okay. Here's the rest. Baltimore.
Oh.
Charlotte, North Carolina.
Oh.
Miami, Florida.
Yeah, okay.
Yeah, you can kind of see Miami. Nashville, Tennessee.
Oh, shoot.
Because of the tourism. Nashville is increasingly tourism reliant.
Interesting.
Oklahoma City.
Wow.
Because I think also oil in Oklahoma City. It's
probably. Yeah. Okay.
And then here are the two that really surprised me because they've been such darlings of the rent growth. Austin and San Antonio.
Wow, really?
Yeah, are on the top 10 list of rent declines in rent. So actually Miami, Florida is number 1. Austin is number 4. Austin actually beats out Las Vegas.
For rent drops?
Rent drops. Almost 1% in a month.
That is interesting.
Number 5 is Las Vegas. 6, wow. I'll just round it. 6, Nashville. 7, Charlotte. 8, Houston. So Houston's all the way down to 8. 9, Oklahoma City. And then 10, San Antonio.
That's interesting to me because a lot of people, again, a lot of California investors have been screaming at me for years. They want to buy out of state in some of those markets, right? Nashville was a darling for quite a while. Austin as well.
The only one of those super hot markets that's not on the list is Dallas-Fort Worth, right? That's the other, that's the hot market that everybody wanted to get into, but you're talking about
Plano and Dallas. Yeah.
Nashville, San Antonio,
you're right.
Austin, these are
Charlotte.
Charlotte, right? So this is
crazy.
Is like very, very interesting data. And let's see what it says here about the reasons.
I wonder if that's a supply demand problem. I wonder if too much supply is coming on the market.
Well, that is probably part of it, right? That's probably part of it. And also, again, like to be fair, this is not breaking it down by A, B, and C.
Yeah, that's true.
So it's just the market overall. So it's probably fair to assume that at least some of this has to do with the top end of the market, all this new supply that's coming on in these cities.
Yeah.
And they can't lease up, so they're dropping rents and increasing concessions.
For sure.
To lease up.
I would absolutely assume that's valid. Yes.
Yeah. But maybe not Oklahoma City. I don't think that's actually been
that's probably oil, though, to your point.
Yeah. That's been a city that hasn't,
it has been on the list. Yeah.
Hasn't been on the radar. So
interesting.
So there's less demand for rentals, and because it's, complete, it's because people just aren't moving and there's more unemployment.
Well, so also, I think I brought this up with you before. I think there are going to be a larger percentage than normal of people who could afford a Class A apartment that decide to buy a house.
Mm.
They're going to go, hey, net, I'm about even. I freaking hate people always remember the last crisis.
Yeah.
And this last crisis is going to equal space is good. I want a backyard. I want a front yard. I want to park my car in a garage.
Yeah. Well, listen, anecdotally, what I've been hearing is here in New York that real estate brokers up in the Hudson Valley have had their phones ringing off the hooks.
And how far is Hudson Valley? I don't know.
Anywhere from an hour to 3 hours from here.
Okay.
Right.
Right.
So it's, it's exurban. It's not really suburban. It's kind of country-ish,
but it's
some
houses.
small cities. It's houses, and you can commute to New York on the train from there.
Oh, there
and
you
go.
Okay.
So they've had, I'm sure a lot of this is, most of it will not happen. It's mostly people like kind of tire kicking, but there's definitely going to be some of this happening where people are going to be like, you know what, I've been dealing with the small space for a long time, and I was gonna be fine with it.
We talked about it for years and blah blah blah.
And now it's time to do it. And I think you're right. I think there's going to be people are going to want to move out of the crowded spaces if they can, and at the top end, especially where people have the resources,
they have options.
We've talked before about just on an economic basis where they can afford it, so they'll do it. But I think that's not the only driver anymore, right? There's now two drivers behind this, which is the desire to be distant from other people.
Yeah.
Right.
Crowds are bad.
Or if there's another lockdown, you want to have a backyard that you can go sit in.
Exactly.
And not, so that's driving this. And I think that leaves us with our last topic.
Yes, the favorite. Well, let's one more little fact for you. So again, I've been calling for New York and Bay Area, California to be in trouble. So I got data just this morning on the number of people who have mail forwarding in New York for March and April. Right.
Yeah.
This is from memory, so I'll be off slightly. 56,000 people in March, which was double normal, but 81,000 people in April. So, I don't know, rough and tough, 140,000 people are forwarding mail to somewhere else.
Yeah. I mean, it's all the people who have second homes who have.
Or family. I mean, when you go live with family, right? That's just out of New York.
But it is disproportionately the wealthy areas.
Yeah, Manhattan is the biggest.
Manhattan, the wealthy parts of Brooklyn. Basically, if you look at one of those heat maps, it's like it tracks exactly like the wealthiest neighborhoods, because those are all
they have options again.
They have options. They've got second homes, or they were able to jump on renting. They can afford to pay 2 rents at the same time or whatever.
Exactly.
With Airbnb, like I've just noticed it's a whole lot easier to park in my neighborhood now because at their second homes, which is it's great. But
well, the good thing is we're gonna wrap all of this up with just one of the greatest misconceptions, and that is all of this dry powder on the market or sitting in bank accounts and money market is going to save us. Right? We've talked about some pretty negative trends here, but don't worry, all that cash is going to come in and save us.
That's right. So there has been, now, if you've been following things, you know that there has been an enormous mountain of cash that's been building up on the sidelines, waiting for the crash that everybody knows is coming or was coming. And nobody thought we were going to have a pandemic, but everybody knew that at some point there would be that straw that broke the camel's back and the whole thing would come tumbling down. And there were a lot of people who were getting ready for that. So these were, basically people setting up or, putting dry powder aside for those distress deals, for for the blood in the streets moment when they could buy things for pennies on the dollar. Now, I've been seeing recently an argument on Bigger Pockets and in my own Facebook group that essentially argues, oh, well, multifamily prices aren't going to fall that much because all that money on the sidelines is going to rush in and support the market. The idea being that none of this money wanted to be deployed when the market was strong because it was waiting for a crash. But now that the crash is here, it's going to jump in when it can get a 5 or 10% discount, and that's going to and because supply is limited and there won't be enough supply to go around for all these investors who want a 5% discount, that'll drive the price back up, maybe even higher than it was before because of limited supply. Yeah, honestly, I've heard this argument. It will
Wow.
actually could even drive prices higher than they were before because there won't be enough inventory for everybody to go around.
That's
Which
crazy.
so it's a crazy argument on a number of levels. One is that the fundamentals are deteriorating, which will alone drive prices down, right?
Mm-hmm.
But the other thing is that this money has been on the sidelines specifically waiting for huge bargains. It is not going to be enticed off the sidelines by small bargains, especially if that money believes that there's more bargains to come, right?
Exactly.
If they decide somehow that this is as good as it gets, then arguably it might jump in. But as soon as the pricing gets too high, it'll just pull back out again. It's certainly not going to make multifamily prices rise beyond where they were before. But because that with deteriorating fundamentals, that would have to mean even further cap rate compression, right?
Oh, for sure.
You'd have to have like cap rate compression down to levels that are not even seen in this bubble to make just unheard of, sort of unfathomable cap rate compression when you've got the dropping NOI on top of it to make up for higher prices. But this is not going to happen. You're not going to see this massive wave of that dry powder coming into the market just to pick up a couple of percentage points in bargain when given all the uncertainty, which that money is looking at opportunistically and saying this uncertainty means further price declines and we want to get in as close to the bottom as we can. So that has been my position all along. And happily enough, yesterday an article popped up on National Real Estate Investor from Bloomberg talking about, the headline is "Loaded with Cash, Real Estate Buyers Wait for Sellers to Crack," right? And so they're talking about all this, especially private equity money sitting on the sidelines. And here it is, right? As you and I have been talking, sellers are currently willing to concede discounts of around 5%, while bidders are hoping for about 20% off pre-pandemic prices. And that gap has caused the market to grind to a halt, which is basically what you'd expect. This is what happened the last time. The sellers they're anchored to these very high prices that they expected to get. They're hoping it's going to come back. So they're willing to concede a little bit maybe, but nowhere near what buyers are demanding. And so the idea that, all this money is going to come in for these 5% prices is already put to the lie by the data out there, which is showing that it's not. This money is waiting. It is money that's specifically waiting for blood in the streets, and it's not going to move until it sees that, right?
Yeah, so I've invested in that market before. 2010, we highlighted earlier, was the peak of distress. It was my most active year. What people don't understand is the capital that is dry powder today is very patient capital.
Yes.
Right. It's been on the sidelines for years. It's been earning, frankly, bad returns, right? Because they just wanted it there. And this patient capital is also experienced capital, right? So, I mean, just real world examples, right? I picked up an 18-unit apartment building for $700,000, 100% financed in 2010. It sold in 2006 for $1.41 million. I bought it from the bank. I brought it from the lender for nothing, right? Nothing down. I bought 2 10-unit buildings next to each other from 2 different banks for $22K a door when they sold for $55K a door 5 years earlier. I am patient. This 5% discount stuff, frankly, 20% discount is not enough for me. But again, I play in the Seacrest area. I probably have more pain ahead. But again, I have them bought at a basis. They can go 50% occupancy and I'll be fine. But yeah, these people don't understand. Everybody who's talking about patient capital coming in at a 5% discount has been doing this less than 5 years. They've never saw a down cycle.
Not only that, it's sort of like the same people who say I'm a conservative underwriter, but their underwriting changes, as the market goes up. Their underwriting gets looser and looser, and they continue to say that they're a conservative because they're applying some rule of thumb that somebody taught them that is not meant for a market at all-time highs, right? So it's, just to put things in perspective, now again, we don't know how long this is going to last, but the last recession where you got those amazing bargains, right?
Yeah.
We capped out at about 11% unemployment. We're at 15% unemployment right now.
And rising.
And people are saying that when the data's in, it's going to be worse, right? So, and again, the economy's going to open and a lot of that unemployment is going to drop.
Mm-hmm.
We're probably going to be, like you said, at 10 for a while. We'll probably be at 8 next year. That is going to translate into very similar opportunities.
Yes.
Once, and it's within a specific band, because I know what I'm going to get in reaction to this is, I owned multifamily last time around and I was fine. That's true for a lot of people, right? It's true for a lot of people. If you bought at the right time, if you bought with a low enough basis, you weren't struggling to make your debt service, that's fine. The problem is going to be those people who overpaid for their assets from like 2018, 2019, early 2020.
Yeah.
It's going to be that band of people who are going to be in trouble. And some of the people who bought a little bit earlier who have to roll over bridge debt, right? They got 3-year bridge loans, right? Or they got 3 years of IO and now they're kicking into full amortization. Some of those people are going to have trouble making their debt service. Some of the people who bought around 2016 are going to be rolling over their debt next year.
Oh, that's
true.
Be
rolling over their debt. The ones who, weren't smart enough to get 10-year debt or 7-year debt in 2016,
ouch,
are going to be rolling over their debt next year, and they are not going to be rolling it over at the same valuation that they bought for. Some of them, right? And certainly, I would say most of them are not going to be rolling over at the valuation they underwrote that they were going to get. So,
for sure.
there's going to be some distress, and there's going to be certainly lower pricing across the board, even for just normally on the market stuff, right? So the idea that the cash is going to step in and like make it like it never happened. I mean, that, like you said before, that's disciplined money, and the disciplined money is going to look at the unemployment situation.
For sure.
It's going to look at the NOI, and it's going to say, I'm not paying peak pricing for this asset, which, I never believed it was justified in the first place, which is why I was on the sidelines to begin with.
Exactly.
But now that the underlying fundamentals have changed and there's really no argument that you can make that these prices are justified, I mean, there's no way that I'm going to pay that peak pricing. So the idea is just, it's just laughable that all the dry powder is going to save us, or that the Fed printing money is going to save us, or any of these other things. You can't make people spend money if they don't believe it's worth spending the money, no matter how much money you give them.
No, exactly right. This has been a lot of fun. Again, folks, we're in this parallel universe. The data has been better than we both expected as far as rent collection has gone, but now we understand why. There is going to be pain ahead. The multifamily market is one to stay patient, one to learn. There will be opportunities, but they're not today. The opportunities aren't today. Not in my opinion. So Jonathan, thank you very much. Any closing thoughts?
Yeah, we never did mention the name of my group.
Oh, please.
Which is
Sorry.
Multifamily Investment Community on Facebook. Please join. Be sure to answer the questions when you try to join. And I look forward to seeing you in the group. And Michael, I look forward to seeing you next week.
Absolutely. And again, folks, join the group. I'm in there every day. I love what's going on there. It's actually a source of a lot of data that I use for my financial news. So definitely sign up, answer the questions, and be active. Thank you very much, Jonathan.
Thank you, Michael. See you next week.
Yep.